Statement of Financial Position Learning Quiz. 6 questions to test your understanding of this introduction to the Statement of Financial Position. What are the principal parts of each side of the Statement of Financial Position? There are 2 sides. On one side we have items that a firm owns or is owed, and these are broken into 2 major parts, current assets and non-current assets. On the other side we have the source of funding for the assets, and these are broken down into current liabilities, short-term amounts that are owed to other parties, and non-current liabilities, long-term financing and equity on the other. How are current and non-current assets defined? Current assets are short-term items that the firm owns that it intends to trade or consume within the next 12 months. Current assets also includes cash and amounts that the firm is owed where payment is expected within the next 12 months. Non-current assets are items that the firm intends to hold. These are items the firm owns that it intends to hold for 12 or more months. These include long-term financial investments. Define the accounting equation and explain how it is applied to make the statement of financial position balance. The accounting equation is defined as assets equals liabilities plus equity, or rearranged as equity equals assets minus liability. This can be applied to make the statement of financial position balance by ensuring that when business transactions are recorded in the firm's financial records, they obey the accounting equation. And we'll take an example. When goods are bought on credit, the cost of the goods bought is recorded as an asset under inventory and the corresponding amount as a liability under accounts payable. What is the main difference between the way assets are presented in the Statement of Financial Position in the US and the UK? In the US, assets are shown in order of liquidity, how easy they are to turn into cash, so current assets first and then non-current assets. In the UK, the other way around, most firms show non-current assets first and then current assets. How are current and non-current liabilities defined? Current liabilities are amounts that the firm owes and that are due for payment within the next 12 months. Non-current liabilities are amounts that the firm owes, where payment is due 12 or more months into the future. What is missing from the balance sheet that seriously undermines its usefulness? I have to go back to the definition for requirements for recognition of assets on the balance sheet. Assets are only recorded on the balance sheet if they are owned by the firm and their cost or value is measurable. People working for a firm are of value. In some cases, they are the firm's most valuable assets, but they're not included on the balance sheet as firms cannot own people. Under IFRS, intangible assets are only recognized on the balance sheet if they have been bought or acquired. More generally, intangible asset development costs have to be expensed.